Open your phone right now. The stock market is at a record high. Numbers are green, investors are celebrating, financial news channels are calling it a golden era. Now close your phone and look around you. Your grocery bill went up again, your rent went up, your friend just got laid off. Your cousin is working 2 jobs and still can't save anything. A family member had to borrow money just to get through the month. So you ask yourself, wait, if the economy is doing so well, why does everything feel so terrible? Here's the truth nobody on financial news will say out loud. The stock market is not the economy. It never was. And the sooner you understand how these two things got separated, and who benefits from keeping them apart, the better you'll understand the world you're actually living in. In this video, we're going to cover exactly how the stock market can celebrate while regular people suffer, who actually owns the stock market, and why it matters. The tricks that push stock prices up even when businesses are failing, what the market actually measures, and what it completely ignores, and finally, what this means for your money right now. Let's get into it. So first, what even is the stock market? Most people imagine it as something like a giant scoreboard for the whole economy. If the number goes up, the country is doing well. If it goes down, people are suffering, but that's not what it is. The stock market is simply a place where shares of companies are bought and sold. That's it. It tracks the value of those companies, not your salary, not your rent, not unemployment, not how many people skipped meals this week. Think of it this way. Imagine a city with 1,000 people. 950 of them are struggling, losing jobs, falling behind on bills. But 50 of them own the city's biggest businesses, and those businesses are making record profits. What does the stock market see? Only those 50 businesses. And if those businesses are doing great, the market goes up. Even if 950 people are drowning, that's not a bug, that's how the system was designed. Here's a number that might surprise you. In the United States, the top 10% of households own about 93% of all stocks. The bottom 50%, they own less than 1%. So when the stock market goes up by 20%, who actually gets richer? Not the nurse working double shifts, not the delivery driver, not the factory worker. The people who get richer are the people who already had money to invest in the first place. This is why stock market gains and everyday struggle can exist at the exact same time, because they're happening to completely different groups of people. It's like celebrating that the expensive restaurants in town are fully booked every night, while ignoring that the people washing the dishes can't afford to eat there. And here's where it gets more interesting, because it's not just rich individuals who own stocks. Big institutions do too: pension funds, insurance companies, hedge funds, sovereign wealth funds. These giant players move enormous amounts of money in and out of the market every day. And their decisions are based not on how people are feeling, but on one thing: what will make the number go higher. Now here's where it gets really interesting and honestly a little frustrating. Companies have figured out ways to make their stock price go up even when their actual business isn't doing that well. Let's look at a few of them. The first one is called a stock buyback. Imagine a company has $10 billion sitting in the bank. Instead of using that money to hire more workers, raise salaries, or build new products, the company uses it to buy its own shares from the market. When you reduce the number of shares available, each remaining share becomes worth more. The stock price goes up, investors are happy, the CEO gets a bonus, and not a single new job was created. This is completely legal, and companies do it all the time. The second trick is called earnings manipulation, or more politely, managing expectations. Before a company reports its profits, analysts make predictions. If the company can just beat those predictions, even by 1 cent, the stock goes up, even if the actual profit was terrible. So companies have become very good at lowering expectations just enough before results, then beating them easily. The stock pops. Headlines say better than expected. Nobody mentions that the bar was set on the floor. The third factor is the most powerful of all, and it has nothing to do with any company. It's called interest rates. When interest rates are low, borrowing money is cheap. And when money is cheap, investors don't want to keep it in a savings account earning almost nothing. So they push it into the stock market, searching for any return at all. This floods the market with money and drives prices up. But here's what's happening in the economy at the exact same time. Those same low interest rates that pump up stocks, they also inflate the price of everything else: houses, cars, education. Which makes life more expensive for regular people who aren't seeing any of those stock market gains. So here's the question: if the stock market doesn't measure how regular people are doing, what does measure that? Things like unemployment rates, wage growth, consumer spending, poverty levels, healthcare access, household debt. And when you look at those numbers, they often tell a completely different story from the stock market. Here's a real example. During the COVID-19 pandemic in 2020, millions of people lost their jobs in a matter of weeks. Businesses shut down. People were lining up at food banks. It was one of the worst economic shocks in modern history. And the stock market, it crashed in March 2020, then recovered almost completely by August. By the end of the year, it was at a record high. Meanwhile, millions of people were still unemployed, small businesses were still closed, families were still behind on rent. How? Because governments and central banks pumped trillions of dollars into the financial system to keep it alive. That money flowed into stocks. The market flew up. But much of that money never reached the people who actually needed it. The market recovered. The people didn't, not nearly as fast. So now that you understand how this works, what should you actually do? First, stop using the stock market as a measure of how the economy is treating you. If you're struggling while the market is booming, you are not failing. You are simply not the person the market was designed to measure. Second, understand that the market, despite everything we just said, is still one of the most powerful wealth-building tools available, if you can access it. Even small, consistent investments over a long period of time can grow significantly. The problem isn't the market itself, it's that most people are never given the tools, the income, or the education to participate in it. Third, be skeptical of headlines. Markets hit record high is not the same as everyone is doing great. These are two completely different statements, and conflating them is how a lot of people get confused and misled. And finally, understand the bigger picture here. A system where stock gains flow almost entirely to those who already have wealth, while workers bear the cost of low wages and high prices, is not a natural law of the universe. It is a series of policy choices, and policy choices can be changed. Whether you are just starting to learn about money or you've been frustrated watching the news for years, knowing this is the first step. So, in conclusion, the stock market goes up because of who owns it, how companies manipulate their numbers, and how cheap money inflates prices across the board. It does not go up because regular people are doing better. The market and the economy are two different worlds, running side by side, almost never touching. And the most important thing you can do is stop letting one number, one index on a screen, tell you how the world is actually doing. Because the people writing those green headlines, most of them own the stocks. If this video helped you see something differently, share it with someone who needs to hear it. And if you want to understand more about how money, power, and the economy really work, subscribe. Because there's a lot more coming.